Hi everyone, welcome to our last class on portfolio theory. I hope you've been enjoying the class so far. Let me say that with everything that we are going to do in this class, you should be able to understand portfolio theory from the beginning to the end. In the last class, I said all we have left is capital market line and security market line. I also said I was going to bring some past questions that you can revise. So I gathered some past questions. I got these questions. You can write them down. May 2018, question 4. There was May 2019, question 4. November 2019, question 4. Can you see the pattern? March or July diet. Remember that diet, that COVID year, 2020, question 4. Then in 2021, May, it was also a question 6 at this time. So you can check out these questions. Let's also solve one last question in this class, and that will be all in this class. And with your knowledge here and adequate preparations, you can do anything in portfolio theory. Please, if you see portfolio in the exam, any exam you're writing, whether you're writing this diet or any diet you're writing, please attempt it. Just do it if you really understand these classes. It's always a bonus question. And forex, if you know portfolio and if you know forex, at least you're sure of your section B and C, and God will help you in your section A, where the compulsory question is, right? So this particular question I'm going to be solving is actually in November 2016, question 5, and I'm going to read it as you have on the screen. It says the capital asset pricing model is an equilibrium model of the trade-offs between expected portfolio return and unavoidable risk. They said, what are the basic assumptions on which this model is based? They're asking what are the basic assumptions. So you just write basic assumptions for capital asset pricing model. Okay, the market is a perfect market. Okay, so the investors assume that the market is an ideal market, is a perfect market. Maybe you can just write perfect market, then you explain it. The investors assume that the perfect market, there's free entry and exit, there's no transaction cost, there's no tax, no inflation. That's an assumption because it's not true. In practice, it's not true. The second assumption is that all investors are risk averse. Okay, all investors are risk averse. Is that true? We don't know, but it's an assumption. The third assumption is that every investor have access to the same information. All investors have equal access to information. So there's no hidden information anywhere. If you want to outperform the market, you have to take a higher level of risk. So you can talk about the information. The beta coefficient is the only measure of risk. Now in CAPM, this is even an assumption that you should never forget, because remember the CAPM formula, right? Says that your risk-free rate plus your risk premium. So you are trying to say that this is the only measure of risk. How will you say this is the only measure of risk when we have unsystematic risk, right? We have credit risk somewhere. We have other forms of risk. So these people, they assume that beta coefficient, yes, beta coefficient is the only form of risk, which is not true. So if they ask for limitations, you start countering all these assumptions that there's no perfect market, there's transaction cost, there's tax. Number 5, these people assumed that the market is always at equilibrium. Yes, equilibrium. They assume that the market is always at equilibrium, which is not true. Demand is not actually always equal to supply. But I'm not saying you should write this is not true there, because they're asking you for assumptions. Okay, another assumption is that investors assume that the risk-free rate is actually risk-free. It's treasury bills rates. They are not actually risk-free. There's risk in everything. Okay, so they always, the assumption says that investors believe that they can borrow any amount, they can lend any amount at the risk-free rate. Maybe the risk-free rate is 5%, which is what they commonly give us in the exam, right? 5%. Then investors believe that they can lend or invest any amount at this risk-free rate and nothing will touch it, as in the risk rate will always be risk-free. They will always get that particular amount. Sometimes it can change. Like when COVID came, remember that treasury bills went as low as was it as low as 1.33%? Yes, because I did treasury bills at that time. So TMI. The big part says currently the rate of return on the federal government bonds redeemable at par in the year 2018 is 5%. All that long story is to just tell you that risk-free rate is equal to 5%. Did I say 10%? I don't know why I'm excited today. 5%. The securities of 4 companies, Akira PLC, Bombardier PLC, Courage PLC, and Divine PLC, have expected returns of 12%, 9.5%, 10.5%, and 13% respectively. Let's write that out. Akira, Bombardier, Courage, and Divine. They told us that they have what? 12%, 9.5%, 10.5%, and 13% respectively. The average expected return on market portfolio is 10%. Are you seeing that? The average expected return, that's RM, on market portfolio is 10%, subject to a 6% risk, that is standard deviation. Okay, you see, they put standard deviation in the bracket so that you will not think it is market risk. This is what they are telling you, this unsystematic risk. You know, there are two risks we've talked about in this portfolio. Okay, we've talked about the systematic and the unsystematic. So that market risk, they're saying, is subject to a standard deviation, that is risk of what? 6%. Other relevant information relating to the four securities of the companies is as stated below. They now gave us Akira PLC, Bombardier PLC, Courage PLC, and this. They gave us their standard deviation. So let's write that down. Their standard deviation, they gave it to us at 0.08, 0.075, 0.09, and 0.150. Then they gave us the correlation coefficient as 0.975, 0.640, 0.740, and 0.680. Right? You are required to show which of the following companies is or are overvalued. 9 marks, total 15 marks. Okay. So at the back of your mind, you know somewhere that when you're talking of valued or overvalued, valuation has to do with comparing the stock return and the market return. Okay, and the market return. So you are comparing stock return and market return for A, B, C, and D. You can even just write them down. Akira, Bombardier, Courage, and Daudu, or whatever it's called. The stock return is what? 12%, 9.5%, 10.5%, and 13%. Then your market return, you don't know that. Then you now get the alpha values, that is the difference between the two of them, to know whether it is undervalued or overvalued. Then you can get your strategy. They didn't even ask you for that one, Sha. They just said that you should find out. Then you can now turn and go and get the workings. Okay. So what are you going to go and look for in your workings? You are trying to look for the market return of each stock, because that is what is missing. The market return of each stock or each security. And you know that to get that market return, you have to use what? The CAPM approach. Let the formula guide you. You can see that we started being guided from the requirements. Okay. As the requirements guided us, we constructed our table. And now we know that, okay, it's market return. That is the other variable that we're looking for. Now, to get market return, I say you use CAPM. State your CAPM formula. Okay. That you get your market return on the portfolio by saying your risk-free rate plus beta, right, into your market return, average market return minus your risk-free rate. So your risk-free rate, you have it to be 5%. You know, you are going to calculate for A, B, C, and D. For A, do you have your equity beta? They didn't give you. Instead, they were giving you standard deviation and correlation coefficient. Then you, because you know, because you have come to Tolusule's class and you know this thing, you remember that we did it, that you can calculate this using either correlation coefficient or covariance. But since they gave you correlation coefficient, since you're going to use the correlation coefficient approach, God forbid that your examiner will tell you the approach to use. It is based on information given that you will know the approach to use to get this. They didn't give you the individual beta coefficient. You have to go and calculate it. They gave you this one to be 10%. That's the average market return, and this is 5%. So you have to calculate this for A, for B, for C, and for D. You can see the formula has graduated us into another formula. Okay, so you have to state the formula for calculating your beta. Remember, just calm down. Remember the covariance approach. Always pick covariance first, or the correlation coefficient approach. Ask them, is it covariance or correlation they give us? They give us correlation coefficient. The correlation coefficient formula is that one with big P. Remember that the risk of the security over the risk of the market multiplied by this big P. Remember, between the security and the market. Very simple. So people will now see this portfolio theory and I'm like, I don't know it. Because if you don't know it, you don't know it. This is not theory. Please go and watch all the classes, okay? So for A now, we're going to start calculating for A, B, C, and D. Because by the time we calculate it, we can now get the market return for each and go back and compare and make a decision. So for A, they they gave it to you as 0.08. You write it 0.08 divided by the standard deviation of the market. Remember that they give it to you. They say subject to a 6% risk standard deviation, that's 0.06. Multiply by, they gave you the correlation coefficient of A. That is how correlated is this with the market. Show him boy and Wally. What is the correlation between that security? you're laughing, my darling. What is the correlation between that security and the market? Zero. What is the correlation between that security here and the market? 0.975. First, even write everything. That's for A. For B, 0.075 divided by 0.06 multiplied by 0.640. I might put it on the screen. Let me put it by this side so that you'll be seeing it where I'm getting the figures from. For C, 0.090 divided by 0.06 multiplied by 0.740. For D, 0.150 divided by 0.06 multiplied by 0.680. Can you see? Please, somebody that does not know this formula, because this one is not behind the formula page, annuity page, is not there. So somebody that does not know it, a portfolio, if you don't know it, you just work up past. And that's where they used to steal marks. I'm telling you, from portfolio and forex, two very simple topics. That's where they steal marks from people. And people will not know, everybody will be focusing on compulsory questions, but all these 15 marks questions that you can easily claim 12. As if you don't know anything, you don't really remember, you were rushing, you claim 12 in section A, so that's 24 marks. Then you'll be looking for how to spread your remaining 25 marks because you're trying to get 50. And God will help us in Jesus' name. So just put all of this in your calculator. 0.08 divided by 0.06 times 0.975, and that gives us 1.3. Write it there, 1.3. 0.075 divided by 0.06 times 0.640, that gives us 0.8. Write it there, put the 1.7. You have gotten all of that. Then you go back to your market return. Okay, just say your return for A, return for B, return for C, the specific market return for that. Okay, because it's different from the average market return. We've explained that. And return for D. Okay, so just quickly put that in your formula because you have not gotten anything. This one is just working. Quickly put that in your formula. 5% plus 1.3 into 10% minus 5%. 5% plus 0.8 into 10% minus 5%. 5% plus 1.11 into 10% minus 5%. 5% plus 1.7 into 10% minus 5%. You can see when they said that the systematic risk is the relationship. So you get your answers. You can see it's only the systematic risk that is changing. The beta. It is the beta that changes everything. That's what determines the return on each stock. Okay. So let's do that. You know that this is 5%. So just say 1.3 times 5 plus 5, 11.5%. 0.8 times 5 plus 5, 9%. 1.11 times 5 plus 5, 10.55%. 1.7 times 5 plus 5. Everybody is doing plus 5 because everybody is taking a higher risk. Everybody is taking a higher risk. If you are taking a risk of 0, should I even add down? If you are taking a risk of 0, if you don't take any risk, zero risk, everything here will be 0. You'll get only 5. That's why it's called a risk-free rate. By the time you take a risk of 1, a risk of 1 is always the market risk, right? You get what the market is giving. The market is giving 10%. Okay, if the market is giving 10% and the base risk, that is the risk we are not taking any return, is 5%, it means the extra is 5%. That's what is called market premium. Okay, that's just by the way. So let's now put all of this and use it to compare. So let's take that to the back. We have what did I write again? 11.5%, 9%, 10.55%, and 13.5%. So market said this, they brought this. That's what market undervalued us. You can write the alpha values here. This would be 0.5. Okay, that's not important. Market undervalued, so it is undervalued. This market undervalued. Is it showing? It was not showing. Sorry. Let me say that again. I wrote out everything. So the market is saying A should return 11.5%, but A actually made 12%. So market had undervalued. Here, look at it also. Market had undervalued. Here, market is saying 10.55. This one, they brought 10.50. It's less. So market had overvalued them. They're like, who do you think we are? Market said 13.5, and look at, they brought 13. Market overvalued. Okay, what's the strategy? They didn't ask for that one. What did the question say? The question said you are required to show which of the company is or overvalued. Based on the computation above, company Akira, that is Akira PLC, and Bombardier PLC, is it Bombardier? Akira PLC and Bombardier PLC are undervalued, while Courage PLC and Divine PLC are overvalued. You can put the strategy. Therefore, the strategy for the investors of the company to buy more of the share, to sell, and that is all of that about that question. You guys should practice all these questions. You don't even have to practice just because you know it already. Tolu herself has taught you this thing. All you need to do is to read the question. Just flip through like, I know this, I know this. Okay, I wish you guys success. Okay, let's talk about capital market line and security market line. Very simple. So capital market line is actually everything is a graph, is a line, is a graph. Okay, but the capital market line is a graphical representation of efficient portfolios. What is an efficient portfolio? An efficient portfolio is a portfolio that has the best combination of return and risk. Okay, maximum return for a certain level of risk. Does it make sense? So the capital market line is a graphical representation of the efficient portfolio characterized by highest return and lowest risk. Do you understand? So capital market line is for only portfolio. It reflects a portfolio, as opposed to security market line. This one reflects only the security, just like the word is saying, capital portfolio. Then the security market line only talks about the security. Okay, so both of them are a graphical representation of something, risk and return. Do you get? So for capital market line that focuses on portfolio, any portfolio that is resting outside the capital market line or outside the line is not efficient, meaning that it's not rational to the investor. It doesn't have the best combination of risk and return. You know, if you're taking a risk of, say, 20%, and say it is yielding a return of, say, 5%, it might not really be a perfect mix for the investor. Unlike if you're taking a risk of 20% and it can still give you a return of, say, 80%. So this one to be considered inefficient. So this one is efficient. So it will rest on the capital market line. Basically, the capital market line focuses on portfolio. The security market line is also a visual representation of the capital asset pricing model. Okay, so this security market line relates to capital asset pricing model. So they can ask you the question that what are the assumptions of security market line? They are the same assumptions as capital. They are the same assumption as capital asset pricing model because it's the same concept. Do you understand? And this capital asset pricing model theory affirms that investors require returns greater than the risk-free rate if they are ready to take a higher risk, which is what I've been saying since. Capital asset pricing model. They are telling you that the investor, let's use KE, cost of equity, minimum required rate of return. They require something greater. Something greater. If they want to take a risk higher than the market or higher than the risk-free rate, they want to take like 2 point something, they should get 2 times that premium, the extra that it is given. This one makes sense, right? So that's what the security market line is also saying. And there are some differences. They can ask you to differentiate between capital market line and security market line. Like I have said earlier, the capital market line focuses on efficient portfolios, while the security market line actually focuses on efficient portfolios and non-efficient portfolios. Another difference between capital market line and security market line is that capital market line uses the total risk. You know, we talked about unsystematic risk and we talked about systematic risk. Capital market line along its x-axis, this x-axis here, sorry, risk. Here we have return. It's a graph. I don't think anybody will ask you this one in exam, but just know it, okay? I was saying that capital market line, it uses the combination of both risk. But you see the security market line, CAPM now, you know CAPM, it uses just this, okay? So it uses what? The systematic risk across the x-axis. So this security market line, what it does is that it shows the relationship between the expected return of a security and the risk. Maybe at this level of risk now, the return should be around here. By the time it takes a greater level of risk, the return should be around that rational stuff. The higher the return, the higher the risk. The higher the risk, the higher the return. Thank you guys so much for watching, and I'll see you in our next class. And our next class should be forex or hedging. If you watched up to this point, tell me what you want our next class to be between forex and hedging. That's how you know if you watched up to this point. Thank you so much for watching, and I'll see you in my next class. Bye.